Well, we called it a monster week for the markets last week, and it certainly lived up to that billing. Volatility across the board. Central banks, the Fed, the ECB, the Bank of England, giving us plenty to talk about this week and plenty of volatility to boot. But that wasn't all. A blowout payrolls figure and ISM services PMI print, putting a soft landing back on the cards in the United States, seeing equities slip and treasuries sell off into the weekend as dollar bulls suddenly and violently grabbed control of the FX market. Where do we go next as the dust settles? It's a big show on the Trade Off UK this week, so let's get into it. Well, as I said, it is a big show on the Trade Off UK this week, and let's bring him in without further ado, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, how are you doing? Have you recovered from the busyness of last week just yet?
I'm not sure I have. I'm still wondering what went on Friday afternoon after all those data drops. Quite amazing, really.
It really was, and I think it was almost the worst possible timing for it as well. I mean, we'd kind of had a ridiculously volatile Wednesday and Thursday, all hoping for a quiet sort of glide into the weekend, and then we got that kind of bolt from the blue when it came to payrolls and the PMI print, didn't we? It was sort of the last thing that anyone needed. But without further ado, let's get into the meat of it, and let's get into Topical Thunder. Well, it was tough to know where to start this segment when I sat down this morning and started trying to plan things out, to be honest with you. And I think we've both had trouble getting this down to just 4 topics. But I think the best place to start is probably with those central bank decisions last week. Obviously, they were the highlight on the calendar when you look at it going into last week. And really just to try and think about what did we learn from those central bank meetings. And just to break those down, obviously the Fed raising rates by 25 basis points, the ECB raising rates by 50 basis points, and the Bank of England just down the road, or just in Ryan's background, of course, raising rates by 50 basis points as well. I think what was more interesting than that, though, was what happened in the statement and what those central banks had to say along with those rate decisions, because in many ways, what was a bit surprising was that the Fed and the ECB didn't really change their guidance at all. The Fed obviously maintaining this reference to ongoing increases in the Fed funds rate. Note that is plural, so we would take from that it means at least 2 further rate hikes before we reach the terminal level. The ECB again implying that we're on for a 50 basis point move in March. But of course, the Bank of England drop in reference to the potential for forceful policy action as we move through the remainder of this year. And I think that just reinforces the idea that the BOE are getting very, very close to the end of the tightening cycle. So I think in many ways, I don't know about you, Ryan, but my biggest takeaway from last week was almost what didn't happen and the lack of any changes in guidance that we got from most of these policymakers.
Yeah, I think the biggest confirmation for me was that we are really at the end of the big central bank hike cycle, at least a pause. You know, the Fed, Powell said that, maybe 2 more hikes and they get to their terminal level. The market still underpriced that. It was still pricing in a cut by the end of the year. It wasn't even pricing the ceiling at the end of the meeting. The ECB, Lagarde, straight off the bat from the statement, we are going to hike more. We are going to, do what it takes, whatever, to get inflation under control. Our first 2 lines off the bat were very strong in what the ECB are going to do moving forward. Then we get the Bank of England, and Bailey, he loves to make a mess of things, really, doesn't he? I mean, every time he opens his trap on and sees central bank meetings, the pound drops, and he did it exactly again, and came out with a lot of blather about yes, we see inflation risks, and that will lead us to maybe hike more, but also we might not hike anymore. And you're sitting there thinking, well, what are you going to do? Are you hiking? Are you not hiking? A real shambles from the Bank of England.
Yeah, I mean, you could have used that description to describe the BOE at any point over the last sort of 12 months or so, to be honest. I guess the biggest takeaway from all of that is that, the Fed and the ECB remain pretty resolute and pretty determined in raising rates, in tightening financial conditions, in trying to get inflation under control and setting growth risks to one side, whereas the Bank of England obviously taking a little bit of a different stance. I think inflation is still well north of 10% in the UK, but the BOE seem to think that their job is almost done and are starting to take a little bit of a victory lap. And if you add those together, it doesn't bode well for the pound, which, cable's testing 120 already. I think further downside could be in store there. But speaking of growth and speaking of the data, let's have a look at what happened on Friday. I know you wanted to talk about what we're getting out of the US at the moment.
Yeah, definitely. A complete 180 in terms of the market moves. Dollar ripped after the NFP's ripped after the ISM services number. And, we've been having this discussion. Is it going to be a soft landing or hard landing? These numbers might insinuate they're not going to be a landing at all. The aircraft isn't coming down. It's just going to carry on taking off again and move back up. And the economy could start gaining and building a bit ahead of steam. Obviously, we can't get too balled up on one set of numbers. We had seen previous months of the ISMs coming, a bit lower, the data overall softening, inflation softening. So, is this a bit of a one-off move? I'm in that camp at the moment. I want to see the next month's data coming in and the rest of the data. But, if it does sustain and we do get a bounce in the US economy and all the numbers start ticking up again, could it push the Fed to potentially look to hike further? Because all that'll bring some inflationary pressures as well. Wages will start rising again. It's something we have to be careful of.
Yeah, definitely. I mean, as you say, the payrolls print 517,000 in January. That was a total surprise. I mean, I can't remember the last time I reported a bit of data and then the next words after it were, FYI, this isn't a typo, just to clarify that this was actually where the data came in. It wasn't me fat fingering it on a keyboard. I think it is going to be interesting where things go next, because everyone, and I'm in this camp, has been saying a soft landing is improbable, not necessarily impossible, but improbable for quite some time now. But the data just doesn't seem to want to back that up. The services sector expanding at a very, very healthy pace, job creation faster than anyone could have envisaged. And, yes, there's population effects and all sorts of quirks with the survey, but let's be honest, the number's 517. That's what we all trade off, and that's what the dollar ripped on the back of. That's what we've got to digest. But I think the biggest takeaway from all of that is it's a Goldilocks situation for the US labour market and for the US economy, because you've got the services sector going gangbusters. You've got job creation absolutely rocketing high. You've got unemployment at its lowest level since 1969. And earnings rose by a third of 1% on a monthly basis. And I think unless you really start to see upward pressure intensify on earnings, which is kind of dubious given that the participation rate is now rising quite substantially as well, then it is likely to see the Fed remain more hawkish. It keeps a lid on those potential second round inflation effects. And all in all, it's obviously good news for the greenback. Yeah,
definitely. We saw exactly that on Friday. The dollar couldn't buy a bid for the last few weeks, and now all of a sudden we're in dip buy mode. And if you're long euro, you're going to be selling the rallies at the moment until we get another piece of data or maybe a Powell popping up and saying something different against that.
Yeah, most certainly. And I think just moving on to the greenback, I think it's interesting that actually we're going to start to see perhaps the tide turning against those who were bearish on the dollar. And I think we're going to perhaps start to see the market look at remarks we're getting from Fed policymakers through a slightly different lens, because up to now, and you even saw this on Wednesday, the market was kind of going, fine, you say you're going to hike more, you say it's going to be higher for longer, but we just don't believe you. We don't think the economy is going to withstand it. Well, bang, all of a sudden, you've got two very important, very hard data points saying, actually, a soft landing or even no landing, as you alluded to, is perhaps on the cards. And I think that is going to lead market participants to actually start to perhaps have a little bit more faith in what the Fed are saying and believe that higher for longer rhetoric a little bit more than they have done previously. You've still got well over 50 basis points of cuts priced in the curve as we move through the second half of this year. That will probably have to be priced out at some point if the data remains as firm as it is. And then, of course, from a more technical level, you've got some pretty big levels starting to break down across the G10FX space. Cable's below its 50-day moving average. We mentioned getting rather worryingly close to 120. The Aussie dollar is sub 70 cents. The Kiwi is below its 50-day moving average. The loonie is now trading above 134. The euro at its softest since mid-January. So I think if we see the market really start to buy into this narrative of a soft landing coming in, we see more upside data surprises. We see that differential in economic conditions narrow in the US's favor. We see treasury yields continuing to move higher, and we see equities keep going lower as well, and that risk-off move continue. Then I do think this dollar bullish trend that started on Friday continued today. I think it could have legs to continue for some time.
Yeah, I think that is the possibility. But as I said, I'm not going to get too excited over, two outlier prints, two Goldilocks prints. The pivoters have been in control the last few weeks. They were pushing the end of last year, failing. They were pushing this year, getting a bit more traction, moving the dollar down, moving yields down, trading when the Fed are going to cut rates. They've been given a bloody nose with this data. I don't think they're out the game. I think they're now going to be having to sit back and push harder on their narrative for a while. But all it's going to take is one data point to turn the other way, be it CPI next week or whatever. And, they'll be back in again. They'll be saying, right, thank you very much. You've just given us better dollar levels to add back into our position. So I don't think they're out the game yet. I think there's a long way to go before we can make any firm judgments on the moves we've seen.
Well, it's certainly going to be interesting how it pans out. And as you say, we've got the inflation print next week on Valentine's Day. What a nice present to us all that is. And of course, before then, we've got Fed Chair Powell speaking on Tuesday afternoon. So that is going to be eagerly watched as well. But what's being even more eagerly watched as the market opens this week, at least, is what's going on in Japan, isn't it? Very interesting over there.
Yeah, very different situation. We have a central bank still easing to oblivion and getting firmly down the rabbit hole even further. And, this weekend was a case in point. We've had a rumour that Deputy Governor Amamiya might be in the running for the governorship. And, that's got the market, pretty much selling off yen again because he's seen as a bit of a Kuroda Mark II. I don't think the market is giving up the bone that the Bank of Japan are going to have to change policy soon. Certainly the data is still indicating that inflation is rising and the numbers are coming in to say that they may have to change their tune, whether it's yield curve control again or move towards tightening. But I think we've had a taste from the price move and the move particularly in dollar yen as to what it's going to take if a certain member comes in or comes out, whether they're more hawkish or dovish. So I think particularly for something like dollar yen, we've seen the price move up again. We're still in a range. We still play in that range. We've had a look at the downside now. Maybe we're looking at a move to the upside. Obviously, we have the US side in the equation as well with that data that we've been speaking about. So there's still a lot in the mix. And the Bank of Japan, hopefully in the next week or so, we will have a firmer idea of who's going to be in the hot seat. The market will probably make its last adjustments on that. Depends on who's in the running. Then we get a reaction when the person's actually chosen. We need to see that process as well. But until then, we are starting to get the rumours coming out of Japan, and that's probably going to continue, and it's going to be risky for trading yen pairs.
Yeah, most definitely. I think the two things that I would take away from these reports that are in the Nikkei over the weekend is that the first thing that interests me is the fact that we had a couple of Japanese government officials come out during the Asian session on Monday saying, well, we don't know anything about this. And I think this is more an attempt to try and lean against the rapid weakness that we saw in the yen than actually to quash speculation of Amamiya, or we're going to have to learn how to pronounce his name, getting the job, because I think it's very unlikely that the Nikkei would have got this one wrong. I think the other thing, on a broader point when it comes to the yen and the Bank of Japan, is this is a timing story. This is not a will they normalise or won't they normalise. It's how quickly will they normalise policy. And obviously, if Amamia comes in and gets the job, he is, as you say, sort of Kuroda Mark II. He's authored and been the architect of much of the policies that Kuroda has put in place over the last decade. So that would imply a much slower pace of normalisation. But at the end of the day, we're still going to see, I would expect, an end to YCC this year. We're probably still going to get a rate hike in the second half of the year. So I'm not overly convinced that this short-term news or these short-term movements in the market are going to have that much of an impact on the overall BoJ outlook as we move through the remainder of this year. It's just perhaps things are going to go a little bit slower than we may have once expected. And obviously with Treasury starting to sell off as well, you get a bit of a perfect storm for a softer yen.
Yeah, I think so. I'm not sure I share your sentiment on getting a rate hike at the Bank of Japan. It's going to need to see inflation really kicking off and some big wage numbers coming in the spring and across the new fiscal year. So that still needs to be watched. But definitely, I think we're on the path where the Bank of Japan is going to slowly move away from their easing measures, and we'll see what that brings us.
Yeah, definitely. I don't think there's any going back there. In that case, let's move on to That's the Setup. Cool. Time for some charts then, in that case. We'll kick off with Euro Sterling. This was my play of the day last week, and I'm not just choosing it because it came off. We actually had a 4 out of 4 hit rate on the Trade-Off UK and the Trade-Off Australia last week on our plays of the day. So let's see. Stay tuned and see if we can keep that up a little bit later on. The reason I'm looking at this is because things have panned out pretty much exactly as we expected. The ECB reaffirming their place as a very determined hiker when it comes to getting rates, to raising rates through into the spring. The Bank of England, again, kind of dragging their heels and cementing their place as one of the more reluctant hikers when it comes to G10 central banks. I think it's getting interesting because we've obviously broken above the 89 level, which was the top of the range that we traded throughout December and most of January. We're getting near this 90 mark now, and I just wonder whether 90 is going to be a bit of a psychological level where people take a little bit of risk, a little bit of profit off the table. The RSI is getting a little bit near 70 as well, which may cause a few to just reassess and take a bit of a pause for breath. But I think if we can wrestle our way north of that 90 mark, then obviously the fundamentals point to euro sterling higher. The technicals will start to point that way as well. And unless we see a significant change in the Bank of England stance, which is unlikely, or we see a significant improvement in UK data, it pains me to say it, but I think sterling could be in for a pretty tough spell against its rival just across the channel.
Yeah, definitely a pair I've been long for some time and was trading it all last year from the long side off the lows. This is looking like a decent break above the 89 level, which has been a big sticky point over the last few weeks. It's holding that gain for now. Below sort of 88, 60, 70, things might look a little bit soggier. But yeah, I think we're going to potentially get a move on to the big figure there. Like you say, it's probably going to be a bit of a big speed hump to get over. But if we do that, then maybe the sky's the limit. Maybe, get up to those 92s, 93s that we saw previously. So, yeah, a good trade to keep an eye on this one.
Indeed. And all of a sudden, our booze cruises and our summer holidays down in Spain and on the Mediterranean suddenly become a hell of a lot more expensive. What a brilliant summer we've got to look forward to. What about the yen? We seem to have a very yen-heavy show today.
Yeah, definitely. Well, you've got to go with what's happening in the markets, haven't you? And we've spoken about this one before. I showed this chart a while back. I've got a bit of a zone here between the 127s and 134.5. And we've tried the downside. We haven't managed to get back down to those 127s. 128s is now the next line of support. Obviously, we're now trading up in the 132s. So if we're not going down, obviously there's only one other way to go. So now we're going to look to see if the top side of this range is going to get a test and see if it holds and see if it confirms maybe a period of consolidation. So we're in the 132s at the moment, creeping up. 133s, 133.30 is a bit of a prior area, some old fib action in there and prior support and resistance. Above there is 134, 134.50 and that fake out we had earlier on in the year, just above 134.50. So for me, I'm short this pair. I'm happy to be in shorts. This for me is the perfect chance to maybe add to those shorts. I'm looking at that 133 area and the 134s. If we get above the 134s, then maybe something has definitely changed and we're going to be taking back some of the falls that we saw in the latter part of last year. I personally think the ranges are going to hold just like they did on the downside, unless the data starts saying something's changed again. What do you make of it, this one?
No, I would tend to agree. I think that range is probably going to remain intact for now, and then you start looking to, what's the catalyst that could cause us to break there. And again, it brings us back to that US inflation print on the 14th of February. If we see a hotter than expected print there, then all of a sudden you've got a labour market that's on fire, albeit with earnings pressure a little bit more restrained. The services sector going very, very well. The manufacturing sector not doing too badly, and inflation moving higher again, and all of a sudden you've got yields going higher, and the Fed, the market buying into the Fed being more hawkish for longer. Obviously, on the flip side of that, if you get a cooler than expected number, you would expect us to come back towards the midpoint or even the bottom part of that range. But I think it's a range play for now. Bide your time until that inflation print, and then react to where that comes out, and be a little bit more nimble. This is of all the pairs in the FX space, in the G10 space, dollar yen is by far the one that's the most sensitive to shifts in rates and rate expectations. So if you are trading dollar yen, then you need to have treasuries and you need to have swap curves firmly on your radar, I think.
Yeah, definitely, 100%.
Cool. Well, let's get away from swap curves because that can get a bit technical. Let's get to something a bit more simple. The FTSE 100, it hit an all-time high on Friday. Finally, we've been waiting years for this to happen. I think the last record we notched in the FTSE was back in about 2018. So while the S&P and every other index you can imagine spent pre-COVID notching all-time high after all-time high, the FTSE never joined in that party. But it has, finally, at last. And I think more gains could be ahead. And I would actually favour playing the FTSE and from the long side at the moment. Let me make this very clear. This is the FTSE 100. I would favour playing that from the long side because it's got a heavy international exposure. So as you can see from the bottom of that chart, the correlation between the FTSE 100 and the pound is at its most negative since 2020, kind of July, August 2020. Personally, I'm bearish on the pound, so that's going to be another tailwind for the major UK benchmark. And the other reason why I favour being long the FTSE 100 at the moment is because you still see this broad sort of preference in the market for a rotation out of the United States, a rotation out of growth and into value. And of course, that's something that the FTSE fulfills, the characteristics of the index. Now, be very, very careful in terms of the FTSE 250, which is a much more domestically focused index. That's not something I'd be wanting to touch with a barge pole at the moment, given how soft consumer demand is likely to be here in the UK. But the headline FTSE 100, I think this looks very, very good to move towards 8,000 and further above that level. And at the moment, it's one-way traffic for the bulls.
Yeah, definitely. And, I have a question for you, and maybe one that a lot of viewers might ask is, if the FTSE 250 is more a domestic view of the UK economy, we know the FTSE 100 is more international. How do you play between the two? You can't, in effect, say, okay, the 100 is the de facto UK market. How do you judge what the influences are for this one? Is it more internationally led? Is it, as you say, a flight to value, because there's obviously some big long time companies in there, good track record, solid companies. Is that how you match it off?
Yeah, most definitely. I think the other thing that the FTSE 100 has got going for it, particularly from a longer term investment point of view, is the dividend yield. And I haven't done my homework, so I don't have it in front of me. But the dividend yield on the FTSE 100 is significantly higher than that of other major global benchmarks. And also the other thing is, look where FTSE 100 firms get their revenue and get their profits from. The vast majority of them are from overseas. So from a trading point of view, the setup is long FTSE 100. From I want a bellwether for the UK economy point of view, this is probably the worst index you can look at. Look at the FTSE 250, it's down 6% over the last 12 months. And there's a pretty good reason for that, because the UK economy, as we know, is not doing well. You look at retail sales, they are not pretty at all. You look at restaurants and bars and pubs, they're not exactly heaving at the moment. They are in the city, but out in the suburbs and in the towns and in the country, they're not. So it's no surprise to see pure domestic stocks struggling a little bit more. But that's enough on the UK. What about your final chart?
Yeah, this one is more of a technical chart. When we trade and people who trade with the technicals, you're always looking for that perfect pattern, perfect number. Yeah, you are the technical king.
I'll just have a nap.
Yeah, you don't need to hit any of this. But technical perfection is hard to find. But now and again, you get a market or an asset, and it's unbelievably resilient to the technicals. It's almost, as I say, perfection, trading perfection. And EURCAD is one that really has been doing that up at the highs here, around about this 146, 40.50 area. It's been a solid line. And as you can see from the chart there, it goes all the way back into last year and indeed further. And this has been a really good technical one to trade. If you look at the middle of the chart there, you'll see we had a series of support lines in the 133, 134 area. Magical support. Every time you traded that number, you got some decent pips out of it. And the same things happen here up at these high points, 146, 40-ish. Every time it gets up there, it gets rejected. So there's a good chance here to play a bit of a range here. The downside is 144. That's your risk level. If we break under there, then potentially we're heading a bit lower. Conversely, if you want to short against those highs, as they say, a level's a level until it's not. You've got maybe some room there to keep trading shorts up there. Conversely, if we do break, the break is likely to be big. So you don't need to, put the house on it on shorts into that level. Look for perhaps a reverse into a long if it breaks. If you're not sure about that, wait for a confirmation. Let it break, let it do its thing. If it comes back and tests that level and holds, then perhaps it's off to the races then. But in technical perspective, this is a doozy.
Well, as everyone knows, I am the world's biggest fan of technical analysis. It has its place, it has its merits, and as you say, that what can't speak can't lie, as a famous South London market trader once said. You really can't argue with this. But I'm not going to talk about the CAD too much just yet, because I'm going to talk about that in my play of the day, which is next. So, as I alluded to, dollar CAD, that is my play of the day this week. And I want to be long dollar CAD at the moment, particularly above the 134 mark. In fact, I'm starting to think about getting long the dollar, the US dollar, of course, across G10. And when we come to put this play of the day together, obviously, we can only pick one trade. So, you pick your highest conviction idea. Dollar CAD is that for me at the moment. I think the Canadian dollar is a good way to express a bullish dollar view, because it's got a lot of things working against it. The Bank of Canada have already hit pause on the tightening cycle in Canada, and we're looking at rate cuts starting to be priced in as early as the end of the third quarter, so September later this year. You've got a very, very fragile housing market in Canada, which is also likely to lead the BOC to loosen sooner rather than later. And of course, commodity prices are starting to roll over in quite a big way as well. Oil was down, both Brent and WTI, around about 8% or so last week, which is obviously a pretty stiff headwind for the Canadian dollar. So now that we've had a closing break of 134, I look for dollar CAD to move towards these moving averages around 135, 135.25, 135.35. And if we can break that, then that big 137 level which we traded at earlier this year and towards the end of last year, starts to come into view. Obviously, if we see crude rebound, if we see the Fed begin to sing from a more dovish hymn sheet, then I start to reassess this view. But for now, dollar CAD above 134, I like this long. What about you, Ryan? Dollar Hong Kong.
Yeah, this is my play of the day. This is a trade I did last year. For those that may not know, the Hong Kong Monetary Authority, the de facto central bank of Hong Kong, they run a trading band for dollar Hong Kong between 7.75 and 7.85. As you can see from the chart there, they don't let it go out of either side. So this one is purely a trade looking to have the HKMA on your back as a bit of a stop loss. We're right up against the band now. I'm looking to get back into shorts. I've got a little bit of short on that I kept from the prior move. I didn't quite get my 7.76 that I was looking for by about 30 pips. So I didn't get out all the trade there. But I'm looking to add back in as we're right up against this band. 7.8495, sitting it, real tight stop, 7.8650. If something happens, we should get a bit of an inside info about it. You know, if they are going to get quaky on the peg itself or the band. It's potentially a low-risk trade. Never say never in this game, of course. We know from the S&B how that turned out. But this one, they constantly see the market trying to fight it. And we've had some big names trying to push the boundaries here and trade options on a break. They stand firm. So pretty low-risk shorting to be shorting up into the top of this band and sit on it and see what happens.
Indeed, I like it. Brilliant. Well, that brings us to the end of this week's episode. Thank you very much to everyone for watching. You'll notice that I've, as always, every week, done this episode wearing a tie, because unlike a certain Mr. Western, my shirts fit and I can do my top button up. But having watched, having watched the Trade Off UK, do go and check out Mr. Western's Trade Off Australia. It is the original, but in no way is it better than what Ryan and I are putting together. Ryan and I will see you again this time next week. Thank you to Ryan for joining me. Thank you also to Kyriakos, our producer, without whom none of this would happen. Have a very good week ahead, and we'll speak to you again this time next week. Thanks for watching. Goodbye for now.